Vision RVSN is hovering around zero point 0.4 in the latest pricing window with a market cap near 2,000 thousands and revenue is about 8,000 while net losses are about 12,000. On paper that looks like a tiny company with a big cash burn. And then came the headline that changed the tone. On 2025 12/1, Vision announced an agreement to acquire 51% of quantum transportation, tying the story to quantum computing and artificial intelligence in transportation. For investors, that creates two conflicting reactions at once. One is the hope that the company is jumping onto a new growth curve. The other is the fear that the company needed a louder narrative because the clock is ticking. The core business is straightforward. Vision develops detection systems for trains. Think cameras and thermal sensing mounted on the front of a locomotive, paired with rugged onboard computing that can analyze data in real time. Thermal sensing helps when visibility is poor, like at night or in fog. Onboard computing matters because trains run through areas where connectivity can be unreliable and decisions need to happen immediately. The company also talks about predictive maintenance, which in plain terms means spotting early warning signals in data before a failure happens, so accidents and costs can be reduced. For rail operators, safety and cost control are the two biggest levers. If the system reduces false alarms and missed detections while improving uptime, the purchase logic becomes real. But rail is a conservative industry. The typical path for new technology is predictable. First comes a proof of concept deployment on a small number of locomotives. The operator tests accuracy, false positives, false negatives, durability, and day-to-day usability. Next comes regulatory approvals and certifications, because rail safety rules are tough and procurement is slow. Only after those gates do larger rollout orders happen, followed by repeat orders. That is the normal rhythm. It is why rail technology companies often feel slow until momentum finally breaks. Vision has left some real breadcrumbs on that path. On 2024 12/27, the company said its mainline product received rail regulation approval in Israel, and that the approval triggered an immediate payment of about $3,000. When approval connects directly to cash, it is more than marketing. It is a proof that a real gate was passed. On 2025 1/10, Vision announced a purchase order from a Central American freight rail operator and described it as a proof of concept program. Proof of concept is standard, but investors rarely relax at that word. In the real world, many pilots never scale, sometimes because performance is mixed, sometimes because budgets change, and sometimes because priorities shift. So the market waits for what matters more, what comes after the pilot. A key follow-up clue arrived on 2025 6/3. Vision reported a follow-on order of about 3,000 from a major Latin American mining customer after a successful trial. Follow-on matters because it suggests the trial did not die quietly. In harsh environments like mining logistics, equipment durability is tested hard. A repeat purchase hints at practical value and the possibility of recurring revenue. From a fundamentals perspective, that is the kind of evidence investors look for, especially when the revenue base is still small. At the same time, there is a sharper threat that can move the stock more directly than any product demo. Nasdaq minimum bid compliance. On 2025 3/7 Vision disclosed it received a notice tied to the one minimum bid requirement, stating the closing bid had been below one during the relevant window. If listing status becomes uncertain, the damage is not just psychological. Investor confidence can weaken, financing can become more expensive, and long-term customers can become more cautious. On 2025 9, the company reported it received an additional 180-day extension with a compliance deadline of 2026 3/2. This is where the conflict becomes painful. Rail adoption is slow, but the deadline is fast. Investors stop thinking only about technology and start thinking about time. And then, right inside that pressure zone, the company escalated the narrative. On 2025 9/30, Vision announced a term sheet to acquire 51% of quantum transportation. On 2025 12/1, it announced the acquisition agreement. This is where the fundamentals-linked mystery begins. because the move looks different than the usual playbook. Typically, a company stabilizes its core recurring revenue first, then expands into adjacent areas or makes acquisitions to accelerate a proven machine. In simple terms, most companies try to strengthen the roots before growing a big new branch. Here, the branch looks big and hard to explain, while the roots still look thin. So investors build competing hypotheses. The optimistic hypothesis is real synergy. Maybe quantum error correction and advanced AI improve prediction accuracy, reduce costly false alarms, and sharpen maintenance forecasting enough that customers pay more and scale deployments faster. If that happens, the market may re-rate the company from a hardware seller toward a higher value analytics platform story. The skeptical hypothesis is narrative expansion. When compliance clocks and cash needs tighten, a company may reach for a stronger keyword to attract attention and capital. Keywords can create short-term flows, but if revenue does not follow, the disappointment can be brutal. A third hypothesis is financing structure pressure. The acquisition structure included roughly 5% equity issuance and up to about $70,000 in convertible loan financing. Convertible loans can become dilution, and dilution fears tend to grow when prices are already low. When investors see that mix, many conclude the company is under cash pressure, even if progress exists in the core business. Another layer of mystery is the choice of 51%. In many strategic situations, companies start with partnerships or minority stakes to limit risk and test real-world synergy. That is how it usually goes. A controlling stake carries heavier responsibility and potentially higher integration cost. Choosing control suggests urgency or conviction, or it suggests negotiation constraints. Outsiders do not know which. Not knowing is the fuel of the mystery, and mystery increases volatility. The chart reflects that indecision. The recent close was 0.3873 with pre-market around 0.3899. The day range was roughly 0.36 to 0.39. The 52-week range spans roughly 0.27 to 2.72, which says the market has already priced in both euphoria and reset. If RSI sits near 50, that reads like a neutral market that cannot commit. With MACD discussed in negative territory, it suggests the uptrend is not confirmed. With the 200-day moving average referenced around 0.49, price under 0.4 sits below a meaningful longer-term resistance zone. Many traders will view 0.49 as a trust threshold, not just a number. So where does this leave the narrative right now? Rail Vision sits between two tracks. One is the slow but tangible path of regulatory approval, proof of concept deployments, and follow-on orders. The other is the fast, high-concept story of quantum transportation through a controlling acquisition. If the two tracks merge into customer value that shows up as repeat orders, larger contracts, and improving loss dynamics, the market has a reason to reprice the stock above the 0.49 resistance area. If the merge stalls, the small revenue base, large losses, compliance pressure, and dilution fears can reinforce each other and weigh on price. In the short term, a practical framework is to respect levels. Around 0.36 is a support candidate. A clean break below can shift sentiment toward the low 30 area quickly. Around 0.40 can act as a trigger level if momentum builds. Around 0.49 is the key resistance area tied to the longer-term average reference. In the medium term, the 0.49 to 0.50 zone becomes the main decision point. In the long term, the only durable thesis is verification. Does the acquisition story translate into measurable performance gains, cost reductions, and bigger procurement outcomes? And does the core business keep producing follow-on orders that turn pilots into deployment scale? Before we close, I want to hear from you. The ValueStir channel is actively looking for your tips on public stocks, private companies, planned listings, and crypto assets that you think deserve deeper investigation. Leave a comment with the ticker or name and tell me what feels off or what feels compelling, like a filing detail, a financing twist, an unusual timeline move, or a number that does not add up. Your leads shape what we investigate next. Thank you to everyone who watches, subscribes, hits like, comments, and shares these videos outside the platform. Your support keeps this work moving, and I will repay it with stronger, clearer, and more useful content. This was ValueStir.